Okay, so yeah, welcome to the dark forest. Today we're going to speak about the malpractices, the trading malpractices that can occur in decentralized finance that have close ties to traditional finance. And as such, there's this book from Michael Lewis that's beautifully exposing the past trading malpractices that very creative traders have come up with in traditional finance. So I mentioned already while I was muted that Investopedia is an excellent source of a variety of practices that you can get inspired by and that you can take from the traditional finance domain and apply to the DeFi domain. So some of them might work out of the box, some of them might not. But it's really interesting because the DeFi ecosystem nowadays is so transparent that we can see a lot what's happening. So we as researchers, we can really understand whether these malpractices are occurring and to what extent they're occurring. Right? So we can quantify how much malpractices or market manipulations are happening. In the traditional finance domain, there are moreover regulators that are deciding what is legal and what is illegal, or what should not be done. And in particular, in the US, we have the SEC. It's a regulatory body which is trying to regulate the market in a sense of regulating what companies or normal people should and should not do on the stock exchange and in the finance domain in general. And they're not only set up the rules, they also enforce the rules, meaning that they can sue companies, so natural and regular persons, if they are conducting malpractices. And that's something that the SEC has been doing for many years. Now, in the DeFi domain, the decentralized finance domain, there currently do not exist real regulations, especially in terms of front running that we'll discuss today. So this space as a whole is really a gray zone. We don't really know what is illegal and what not. Having said that, if you act with the intent to steal somebody's money, it's just a regular crime, right? So there are certain parts of the law that are still, I believe to understand are still applicable in the same way. Okay, enough about DeFi, but what is DeFi actually? What is this construct? What is this alternative finance system that has been built on top of blockchains? Well, we all know that we have here this distributed database, which allows to have atomic settlement. So you can perform several actions within one transaction and make sure that if one of them fails, then the others will fail collectively. So this is the atomicity property, which is a great feature we have in DeFi that does not exist per default in the traditional finance domain. And a blockchain, as most of you likely know, is built on top of a peer-to-peer network layer where the data is disseminated. This is where peers exchange information about which trades they would want to execute. We have the consensus layer. And then on top of this, we have the application or the logic state. And this is where we can encode DeFi or finance-related smart contracts. So what you see on top are like a selection of apps or dApps, if you want, such as exchanges, lending and borrowing platforms, flash loans, which is a very special type of loan. I'm happy to go into further after the end if you have time. Stable coins, I'm sure you have all heard about the Terra Luna event. This was a stable or maybe not so stable coin. We have financial instruments such as derivatives. A derivative is nothing else than just a copy or wrapped version of another asset, really. We have privacy mixers that use, for example, zero knowledge proof to break the linkability between a depositor and a withdrawer. They're quite active in the DeFi ecosystem, at least. Okay, so these are the dApps. But what makes DeFi special is not only the non-custodial property that you hold your own coins with your private key, It's also that we have a list of asset standards. So here on the top left, we have typically on a blockchain, we have a native coin, which is used to pay for fees to the miners. And then we have a standard for fungible as well as for non-fungible tokens. For example, ERC20 is a fungible token standard. The ERC721 is a non-fungible token standard. And what's interesting is that all these dApps, they use and are interoperable with these standards. That means the community somehow managed in a very decentralized way to agree all on these standards, which is so beautiful, right? There's no centralized entity that decided this should be the standard. But the de facto standard emerged, and this is what makes DeFi composable. So I mentioned here in slides atomic composability. So we already discussed the atomic property, and composability means that we can perform a swap in an exchange. Then we put the resulting coins into a borrowing or lending platform. There we get then, for example, if we collateralize something, we get a so-called liquidity provider token. That one we can provide to a derivative platform, and that coin we can then put in the flash loan pool. So you can literally chain actions as if you have some kind of money Lego that you can play with, right? And this composability is quite powerful, and it's also something that makes it harder to understand what's happening, right? We as researchers, we try to disentangle sometimes the complexity, we try to simplify, and composability is something that at times makes things look quite complicated, even if it's maybe not that complicated. All right, so this is the base, this is the architecture and of this alternative financial system. And whenever you have a financial system or such applications that transmit or exchange value, you get a certain set of market mechanisms that come along. The most common is arbitrage. So arbitrage is defined as if you have, for example, two markets with the same assets, X and Y. If one of the markets is more expensive, then people will arbitrage them out to balance the prices on both markets. And this is profitable because you can gain value on the spread between those two markets. And liquidations is another example, which is considered benign as well, along arbitrage, whereby in the lending and borrowing platform, if you collateralize an asset and that collateral drops in value, you might get liquidated. It's basically the same as if you take a loan with your bank, and the bank liquidates you because the value of your home decreases, for instance. We have governance and we have security deposits, for example, in payment channels or similar constructs. All right, so this is DeFi, right? So we spent quite some time here just on the architecture to have a common vocabulary and understanding of the mechanisms. But what is blockchain extractable value then? Well, I just mentioned the lending protocol. So in a lending protocol, what you do is you provide an asset as a collateral. For example, you can collateralize Ether into a pool, and this is your security. This is your security deposit that you provide because you want to borrow, for example, DAI, right? That's like in MakerDAO. You deposit Ether and then you can mint DAI. So what you then have once you deposit Ether is you have this Ether value plus the DAI that you borrow out of this pool. So your overall financial value becomes higher. And what people often do in blockchains is they then take this DAI and they buy Ether again. And they do this because they want to be leveraged. They want to have a bigger exposure to this asset, this supposedly volatile asset Ether. Right? Just one example. Now the problem is if Ether declines in value, as we have seen recently, then the security deposit loses in value. So the lending protocol will not be very happy to have a worthless collateral as such. Right? So once your collateral drops below a so-called health factor, your collateral opens up to liquidation. So you can be liquidated. And liquidated means that somebody can come along and buy your collateral at a discount. So who? The question is, who's someone? Right? So in a blockchain-based system, we don't really know. It can be a trader, it can be some kind of it can be a miner, or maybe somebody who's part of this dark forest. So it's not very clear who will liquidate. In essence, everybody can liquidate. It's a permissionless system. When you have a mortgage with your bank, there's only probably one person or one entity that can liquidate your mortgage, right? Which is the bank. But in DeFi, at least in permissionless DeFi, there are multiple entities that can liquidate and perform this liquidation. So, and this is one example of blockchain extractable value, because you can extract value from the blockchain. So I don't have any formal or concise definition of blockchain extractable value. I will just give you a few examples today. But yeah, I invite you to try to come up with some more formal definitions. I believe it's not that simple. Okay, so the second component to get into blockchain extractable value is the transaction ordering. If a miner here receives 3 transactions, 3, 2, 1, in that very same order, the miner may choose to reorder those transactions and may come up with, for example, this order. So why would the miner do that? Any idea? Because of gas? Sorry? Exactly. So the miner may choose to select transaction 2 ahead of 1 and 3 because that might be the more profitable order. Thank you. And a miner, at least in a proof of work setting, has the single-handed ability to reorder transactions at will. I believe to understand that in most proof of stake settings, that's the same case. And so as such, this is just a generic kind of problem or market mechanism that we have to live with, right? And this transaction ordering is at the very source of all market manipulations and extractable value extractions that we're going to look at today as well. Okay, so how much value was extracted? Any guesses? Over like a year or 2 years, how much do you think? A million, 2 million, 10 million? So we measured over 32 months, we measured $500 million in US dollar profit on the Ethereum blockchain alone. So this was from December 2018 to August 2021. And our data set is just the Ethereum blockchain. So we have about 11,000 unique addresses that we captured in that time frame, about 50,000 cryptocurrencies, about 60,000 on-chain markets. And what's quite important is that in an initial version of our paper, we captured less. We captured less markets and less cryptocurrencies. And we realized that the small markets matter quite a bit in measuring that value, because the price changes are more significant in these smaller markets. So yeah, I'm glad that the reviewers pushed us to a revision to go deeper. So it was great. So overall, we measured 3 types of blockchain extractable value sources. So they're the sandwich attacks, liquidations, and arbitrage. So we already discussed today liquidations and arbitrage. These are considered benign. They're not malicious. However, sandwich attacks are rather malicious, and they can cost a significant amount of losses to regular users as they do today. So to understand sandwich attacks, let's first dive into what an automated market maker, an exchange, a decentralized exchange is. So the idea of an AMM is to have a smart contract that does the market making autonomously. So maybe you know in traditional finance you have a limit order book where people can enter like I'm willing to sell or buy at that price and this quantity. In an AMM, you don't have such a table. You literally just have this formula where X is the asset quantity of X and Y the asset quantity of Y. And then you have, this has to be constant. The product of X times Y has to be constant. One of the interesting properties of such AMM is that we have instant liquidity. So liquidity in the financial terms means we can always trade, right? If I want to buy some coin or some asset, I can do that at any quantity. And that's a very important property in finance, because if liquidity dries up, so to speak, then people can no longer trade, and that's bad for the financial system. Naturally, if you purchase the asset X, it will increase the price of X because it increases the scarcity of the asset X, and it will decrease the price of Y. So this is really I would say, the formula that's at the core of DeFi. Obviously, there are more complicated AMM mechanisms for packed assets. We won't go into those details today, but this is really the base. So if we plot that very curve, so it looks more or less like this. So on the x-axis, you have the amount x of the asset X, and of the y-axis, it's the asset Y. Now, if we have a given state here in this particular example, where there is 10 coins of the asset X and 30 coins of the asset Y in the market, our constant K is 300. If we want to remove 10 coins from that pool, how many coins do we have to add to the pool so that the AMM is happy to do that trade? Can anybody help me? Sorry? If you want to remove 10 coins of Y, how many coins of X do we have to add to the pool? Sorry? Come again? X should be 15. Okay, that's correct. But what does that mean? So how many coins do we have to add to the pool? Exactly. Very good. That's all you need to know to understand DeFi. We can go home now. I'm kidding, but so this is literally how the AMM works, right? So you need to provide a certain amount of assets to satisfy the constant product formula, and then the pool will return you those assets. And so you're moving along this so-called bonding curve whenever you perform a trade. So if you're a trader here, you supply 5 assets to a pool, you may get 10 assets back. Note here this circle, this blue circle where the trade starts. This is the initial price of that very transaction or the swap that you're executing. Now, what could happen? Well, an adversary could front run you with a transaction A1. So the A1 transaction pushes you down on that bonding curve. So your initial price that you pay will be worse, right? So do you realize how the blue curve, right? The blue sub part of the curve, which is the victim transaction here. This one is now executing at a worse price than before, right? Just visually, this was the initial starting point where we executed the trade. And now we have a front runner, A1, the A1 transaction that executed just before us. And we have a A2 transaction here from the adversary that is selling in the other direction to capitalize on its initial trade. So the reason that the adversary can do such a sandwich attack, because sandwiching in the sense of having 2 transactions squeezing out profit from the victim, is because the victim doesn't specify a fixed price he's willing to pay. So the victim says, I'm happy to pay 2%, a 2% worse price for that very transaction. Right? So there's a bit of a leeway that the victim is happy to go with. And this very leeway can be exploited through sandwich attacks. Okay? Any questions here so far?
Yes. How do you develop a sandwich attack? key or small for these transactions?
Right. Very good question. So I'll repeat it for the audience. The question was, how can you tell apart a sandwich attack from just regular trading, right? And there is no ground truth. I believe there's no fundamental right answer. However, what we've observed on chain is that most attackers perform these types of attacks from the same account. So you immediately know, okay, these are probably from the same account. So they're rather easy to identify through heuristics. Yeah. So that's one of the options on how to distinguish a benign transaction from a sandwich attack. However, there's no ground truth, right? There's no, I mean, it looks obvious, but it's not necessarily provable, so to speak.
I have a follow-up question.
Mm-hmm.
After you publish this work, did you notice any increase in the smartness of attackers trying to anonymize a little bit better themselves, or they just don't care?
That's a good question. So the question is whether we, after publishing the paper, whether we noticed an increase in sophistication of sandwich attacks. We did. So if we look at this chart, so I have to think quickly when our paper was published, but the amounts of sandwich attacks that were extracted grew significantly. So we actually had a hard time publishing our paper at the very beginning. CCS rejected us because they said it's irrelevant. Like at the beginning, we had like only $100 per month of extracted value, and said, well, it's not big enough, it's not relevant. But then the amounts were growing, and we can see here the extracted values grew up to $100 million per month. So we have not seen significant improvements in terms of how sophisticated the adversaries are. Well, we have seen. I mean, we have seen people using increasingly decentralized services to front-run users, like these private or front-running as a service providers. But the idea is always the same. Well, I think I have recently seen a sandwich attack that was targeting Curve Finance, which is a packed asset. It's an automated market maker specialized for packed assets. So for example, US dollar coins. So you have a pool with USDC and USDT, and the slippage, which is the variance of your price, is rather small. Therefore, these pools support significant quantities in trades. You can perform millions of US dollars of transactions with very small price change, which is very attractive for traders. And because the slippage was so low, we have seen little arbitrage there, little sandwich attacks on Curve. However, we have recently found a few sandwich attacks on the order of a few millions, where the adversary is the adversaries that are executing sandwich attacks are taking a risk, because if they go through centralized like flashbot style front run providers, and their transactions, I mean, and there's a blockchain reorg, then it could happen that some of their transactions become public, but are not executed in the sequence that they want to. So they're taking on some risk. So yeah, we've seen some more sophistication, but haven't. I mean, the core concept remains the same.
So it's not sophistication to hide themselves; it's sophistication to perform more.
Yeah, absolutely. Like we haven't seen any. It's kind of obvious if you look on Etherscan on the transaction execution, whether it's a sandwich attack or not. Yeah. Because they're often bundling the transaction in one, like if they can, they're bundling them in an atomic transaction. Sometimes they're not. but we haven't seen any sophistication on the privacy side. Yeah. Very good. So these values have increased significantly in terms of extractions. So these are sandwich attacks. For liquidations, the revenue or that can be extracted is a little bit more volatile. It mostly applies when there are market downturns, because if there's a market downturn, then the collateral values decline and then liquidation events occur. Right? So here you can see we have found roughly up to $90 million in liquidation profits. So for arbitrage, it's quite similar to sandwich attacks. It was rather small in the initial months that we measured. It went up to about 100 million as well in recent months. Very good. So this was about the extracted value that we measured based on heuristics, right? We have no ground truth data, but this is what we estimate was extracted over this time frame. Now, I would like you to show a transaction replay attack that is fourth source of blockchain extractable value. And the idea of a transaction replay attack is really you just copy paste the transaction. So you observe a transaction on the network layer and you replace certain data, you sign the transaction and you broadcast the copy. It's in traditional network security, you would say it's a replay attack. The community also refers to this sometimes as a generalized front-running attack. And in the next slide, I will show you an algorithm that extracts about $35 million in profit, or could have extracted over $35 million in profit over the same 32 months frame I mentioned earlier. We found that about 0.02% of the transactions are vulnerable to such a replay attack. And the algorithm that I show you, it's a very simple string replace. It's nothing sophisticated. Executes in about 0.2 seconds on average. So the algorithm here looks as follows. So if you construct a replay attack, a replay transaction, so what you do is you set the sender to be the adversarial address, right? So if you're the adversary, you set your address there. The value field of the transaction is also copied. So in an Ethereum transaction, you have a field that's called value. That's how much Ether you want to transmit. So just copy paste from the victim transaction. And as an input, what you will use is the same data of your victim transaction, but wherever you find the victim sender, you replace it with your address, with your adversarial address. And that's it, right? So this is what you then broadcast on the peer-to-peer layer or communicate somehow to the miners, this copycat transaction. So we simulated, so we took the historical blockchain states and we have a simulator, or if you want to call it an emulator, where we act as if this is the current head of the blockchain and we execute it on the current head. And we do this over this 32 months time frame. And what we found is these roughly $35 million in profit. And you can see here a little spike. So this was around October 2020. What do you think that spike represents? Sorry? Oh, that's actually a good point. No, it was an attack, a DeFi attack against the Eminence protocol. So I have never used it, but there was a hack against the protocol where I think it was about $10 million were lost. So what's funny about this figure is that this simple algorithm could have replaced an attack. So you could use this kind of algorithm, albeit it's very simple, to attack an attacker. Right? So it could be, if a miner were to use this algorithm on all its transactions and then have some heuristics, whatever an attack could be, they could attack an attacker, so they could perform a sort of white hat hack to secure funds and then pay it back to the victims. Right? So it's just interesting that this kind of technique could complement all the efforts we have done over the years to secure smart contracts. Right? Whether this is ethical or legal, I will leave it up to the lawyers, but it's a technical possibility. All right, so how can we mitigate blockchain extractable value? How can we minimize this kind of extractions? There are a variety of potential solutions. So, I mean, there's some of you are familiar with the Equitas protocol family. So you can try to have fair ordering on the blockchain layer, whatever your definition of fairness is. But you could also design BE mindful decentralized applications. So for example, you could merge multiple automated market makers into one market maker, right? So this might still not fix cross-chain blockchain extractable value, which is likely another interesting study to look into. So how would this merging of DEXs work? Well, let's look at this following. So we have here two markets, right? And if a user performs a swap on one of the markets, then here in this example, the price of X will decline, right? And if this price declines, then there's an arbitrage opportunity that's opened up for other people in this market, in these two markets. And what we observe in practice is that there's a flooding happening in those events where a lot of arbitrageurs are each creating many transactions with the same logic to arbitrage out this opportunity. Right? So this causes overhead on the network layer, right? So this is backrunning. It causes overhead on the network layer. It causes network congestion. It increases the transaction fees, etc. So this is really, it's not ideal, right? It's everybody loses in this kind of game. So a more optimal design for a decentralized application would be where we have some kind of an aggregator, and this aggregator is not a trusted or centralized entity, but a smart contract. So we can have a smart contract that takes in the swap from the user and then performs optimal routing and arbitrage. So it's the smart contract who computes, okay, where should I now send how many coins, right, to which liquidity source? And the advantage here is natural. We don't have this flooding. We don't have the backrunning. The user gets a better exchange rate. The user receives less slippage because he's using multiple pools. The user is mitigating sandwich attacks because the sandwich attacks on the two markets are less profitable for an adversary. So it's overall a healthier design. However, and this is a negative point, the average transaction fee to perform the swap will be higher, right? We have more computations to perform on-chain to find out the optimal routing and arbitrage path. So it's a job, it's a trade-off in that sense. So we have quantified, and at least when we use Uniswap and SushiSwap, when we merge them into one virtual AMM, so to speak, I think we can pay back 90% of the transaction fees to the user. So they would pay an expectation less. However, we obviously have difficulties in measuring how the market would adapt if everybody would go through such aggregators. So that's still something to be understood in the long run. Okay, so as a summary, we have three main sources of blockchain extractable value that we looked into. So this is liquidation, arbitrage, and sandwich attacks. We've also shown a rather simple transaction replay mechanism. And that one, we quantified how much could have been extracted by emulating past blockchain states. And interestingly, there's a little bit of overlap between the two, but not too much. Yeah. And I'm happy to take any questions if you have. And I have also still time to discuss flash loans if you want, but yeah, I wanted to keep it rather brief.
Thank you very much. Questions?
Sorry, how do you know if?
This replay, you replay some of the examples. How do you know it's profitable?
So you need to track the balance changes. So you choose what we at least did. You choose a base currency that you want to measure profitability in, right? So for example, Ether. Then you look at the beginning of the transaction, how much Ether do you have? And at the end of the transaction, how much Ether do you have? Any coins, like fungible or non-fungible tokens that you receive through that transaction, you will exchange to Ether through, for example, Uniswap, through some DEX.
So basically, just aggregating somebody has a good idea to extract these. Okay.
Exactly. You do not need to understand what the victims is doing, right? That's actually the fun part of it. You don't know why you're making money. So you, you literally just copy paste, and then later you try to understand what happened. But so it's a very good question, because like how can we protect ourselves, right, against this? So one way is to know that the adversary has to be able to quantify whether there's a financial gain or not. And if we can somehow obfuscate, we could use some token that's not tradable on any DEX, then the adversary cannot do this in an atomic, non-risky way. Right? But that's also not trivial, I'd say, to inject such a logic into every transaction we do. I mean, this is just the beginning. It's a very simple algorithm, but there may be many, much more sophisticated algorithms to replay probably all types of attacks and all types of transactions.
You said you ran some simulations that realized the potential profit from this replay in the past. Are you aware of any of the replay attacks also happening in the real world?
So the question for the audience online is whether we have seen replay attacks in the real world. We have. In fact, one of the latest DeFi attacks, I think it was Saddle Finance, where they lost 10 million. There was a Whitehead team that afterwards, after the attack was occurred, they re-executed the attack by simply changing the address to their own address. And it turned out they still got $4 million US through re-executing a successful attack. And they paid back that money. So in that sense, this is a replay attack that's a bit more sophisticated, because it looked at a confirmed on-chain transaction. It tried to just re-execute that one with different addresses, but it was successful, at least in the sense that it yielded some financial profit.
Maybe a quick follow-up to this one. So, I mean, in this case, it's obvious how you, because the white hat things, I guess they lay on that they did this, but is it normally is this detectable?
Whether replay attacks are occurring? I mean, you can, if you're the victim, you can detect it. So the question is whether we can detect replay attacks in real time. So if you're the victim, you know what you're broadcasting in the network, and you know if somebody is front running you with the same transaction logic, right? So because you will see it on chain. Now you're not. I mean, I would say there's no proof that the other person didn't come up with the very same transaction, like at the same time or maybe even before you, right? So it's hard to say, so to speak. There's no proof. I think, it's always there's nothing conclusive, so to speak. But if the transaction that you're replaying is based on your own closed source smart contract that nobody can easily decipher, it's just very likely. Yeah. Which attack do you mean, the sandwich attacks or the transactional replay? No, the transactional replay. Yeah, right. So I think the question was whether the transactional replay is an estimate. No, the volume is an estimate. I would say is we're more certain actually on the transactional replay volume, because we are taking we're taking a blockchain state, right? We replay each transaction in that block on the block head, so on a given blockchain state, and the EVM, so the virtual machine of the blockchain, then tells us whether this is a profitable transaction or not. So there's no heuristic. This is just the EVM telling us whether it's profitable. Exactly. So that's why we wrote potentially extractable. So if a miner would execute this algorithm, that's what they could have gotten. While the others are based on heuristics, and that's what we measured, was what actually happened, what was extracted on chain. Yeah. Yep. Right. So Zita asked whether it's easy to hide sandwich attack extractions, and this is what Matteo also asked. It's not that easy, right? It's really, I mean, you could do a sandwich attacks from different accounts, but it still doesn't. I mean, because the amount that you do in the first transaction, right, to push the victim just to its slippage limit, it's very specific to the victim transaction, right? Right. I mean, on Monero Zcash, there's no AMM, right? So then you don't have this type of. Yeah. I mean, to my understanding, I think it's impossible to create an AMM that's privacy preserving. I would love to see people come up with one that actually is privacy preserving. The problem is you always need to disclose some amount, right? If you want to exchange one asset for another asset, and therefore you're leaking the either the price function or the amount. So I'm actually not aware how we could even construct a privacy preserving AMM. So Zcash, Monero don't have them. Yeah.
We have a follow-up question about so let's take a typical sandwich. Okay.
Yeah.
So what you said is the attacker would use different addresses, but you can still identify the target because this is a sort of targeting a specific transaction, and I guess you're referring to the fact that the user is specifying the tolerance.
Yes,
right?
exactly.
And so the attacker must move within this tolerance,
yep.
the range of the line. But the point is it true that most trading operations will not deviate that much the price of the token, and that will be quite huge to deviate the price of the token beyond the tolerance of the user. So from that point of view, if that is true, then an attack transaction would not be so easily distinguishable from a regular trading transaction of others just by a bit the price of the token. Is
right.
that true or is that false?
I think it's not binary. So the question is whether most transactions fall within the slippage tolerance of the average user. I think that's the question. So depends on the pool that you're looking at and on the liquidity that's in there, right? So for very liquid pools, like highly traded assets, that's certainly true. And if the sandwich attacker is willing to gamble on the coin by not doing the second transaction, I guess it's going to be really hard to know whether they do like a sandwich attack or not. Well, there's still the side channel about whether they pay more gas, or the side channel whether they traded through a front running as a service provider, right?
Yes.
So there's still some side channels that we could still look at, but I agree, then it's hard. For smaller liquidity pools, and that's why we had to cover a lot of pools, right? I would say the slippage tolerance is reached very quickly. Yeah.
So are the attacks always executable with miners? Like do we play small miners?
Ideally, miners should do all those things. But their core business, at least in the proof of work setting, is to get cheap electricity and hardware. So they are currently outsourcing the act of finding these.
But the replay attack, the only thing I use is that transaction is C1, right?
Yep. Right.
But sandwiching requires control. Other 5% of the transactions like this, you might be sandwiched in the wrong way.
Right. So for transaction replay, you need to front run. So the order still matters, right? You need to be faster than your victim. And for sandwich, you're right. You need this order, but you could make an atomic bundle, so to speak. You bundle these 3 transactions into one transaction. You can do this through a smart contract. Or you just pay like the equivalent amount of gas, which, so for front running, you need to pay at least +1 unit of whatever that fee is. And for back running, you pay the same amount. So back running is typically, you literally specify the same amount, and you can assume that the victim transaction is already propagated, and therefore you're going to be after. Right? And we quantified, at least in a paper last year at S&P, that 80% of the miners are ordering according to the price of the transaction. There are some questions online. So Marcus asked, do the transactions for sandwich attacks have to happen in the same block? It's a great question, Marcus. They don't. And we saw that it's quite funny that some of the sandwich attacks happen across blocks even. So like it's mostly the second transaction that was pushed into like the next or like next or second or third block even. So they do not happen to, then they don't have to happen in the same block, because a block is just a virtual unit of it's kind of like a virtual constraint on the number of transactions, right? What matters is the sequence of transactions that execute on a liquidity pool. There's one more question from Johannes. Question from Zoom. Oh no, okay. There's no question. Julia. So the question is, in the cross blockchain setting, if you have 2 blockchains and they have the distinct set of miners, what do we expect? I'm not sure, to be honest. Yeah, it sounds quite tricky, but I suppose miners will still somehow outsource the discovery of profitable transactions to third parties. And the rational thing to do is to extract those. So I guess, yeah, I guess miners will somehow try to extract value, but I'm not sure to see how that will look different from now. Yeah. There must be some more of a risk component, because we don't have atomicity across blockchains for transactions across blockchains, which makes arbitrage more risky, for instance.
Individual transactions. If you try to do something more complex, like you have these 2 transactions and combine them, you have something.
Yeah, that's a great question. So if you are, so we have not done this, but that's certainly something that would be interesting to look into. So if you are, you could potentially bundle multiple victims into one sandwich attack. It's like like a double sandwich or so, probably. Right? I think I saw something like this on Twitter, if I'm not mistaken. So it's certainly possible to do that. The sandwich attack I described here is also only one possible type of sandwich attacks. There are many more forms. For instance, the liquidity providers, they could try to remove their assets from the pool in order to decrease the liquidity in the pool. And then the victim will incur higher slippage for performing the trade. So there are quite some variations of this vanilla type of sandwich attacks that can be done. Yeah, sure. This one?
Yeah, here. How calculate
I mean, these numbers are just examples, right? That I showed, right? So if there's no sandwich attack, we assume this exchange ratio, right? 5 coins against 10, and once there's somebody front running us, we get less. It's just a visual. I mean, these are not based on real data. It's just an example. On how to illustrate that the user here, in fact, is losing assets, right, due to this front-running attack in transaction A1. Sorry? Yes, exactly. That's the profit of the adversary. Yep. So whenever you do a transaction on a decentralized exchange, where there could be some leeway, make sure to tick a low slippage setting, right? Otherwise, you will be scooped up by these high-frequency traders. Okay, when I say high frequency, it's not really high frequency. Like in traditional finance, are much faster. So, but relatively speaking, high frequency.
So basically, can you also see, I guess you were wrong at some point. Can you see programming also as an optimization problem for the user? So like miners just try to work with transactions in a way that their user just benefit the most.
So the question is whether front running or reordering can be used for the good of the user. That can happen. So we are seeing the emergence of services that accept user transactions privately, not broadcast on the peer-to-peer layer, with the consent that the user can be backrun. So arbitrage can be done afterwards, and the profit is shared with the user, but not fully, but shared. So we're seeing that emerging. I expect blockchain wallets in the future to have a button, whatever, send over this backrun me service, private backrun me service, and you will gain more coins. I expect this to happen in a year or two for sure. So because the user is not taking advantage of arbitrage, but he leaves this to professional actors. For sure, this will come. Yeah.
Okay, good. So unless there are further questions, I would say we can thank Olivier for the latest talk.
Thank you.